I think you're addressing a few key points, and that's also something I'm addressing in the article, and that is part of the reason for why I think emerging markets are underappreciated. There's really two things. There's really two reasons why they're underinvested. One is returns. There's no sugarcoating that on average returns in emerging markets are lower than in developed markets, and that is scaring a lot of investors off. And the second one is higher risk, or at least perceived higher risk. And that can be currency risk, which is often the cause of lower returns, political risks, and then also liquidity risks. And that is something that you were addressing in terms of actually getting the exits and getting out of these companies. And all of those are very true and very fair. But I can talk a little bit about why that might not be the right comparison, and why people might still be, despite looking at returns, the headline number, and risks, the headline risk, might still be missing out on interesting things, and how these can be avoided. I think one is, when you look at the overall returns, emerging markets have lower leverage. So that actually gives the developed markets returns an almost unfair boost. So you're not really comparing apples to apples. A lot of managers in emerging markets are also still early in the J curve. So that means they're early in their fund life, because a lot of new funds are being created. And early in the fund life, you're drawing your management fees, but your investments are not creating returns yet. So it kind of looks like you're creating negative returns for the first year or two. So that also depresses the overall average returns. You also have a lot of inexperienced managers, and maybe that's something you're addressing, especially in the smaller and more frontier-y kind of countries. That is something that hopefully will change over time as people pick up, the skills and the right training. And then I think you also have something, and I don't know if the funds that you were working with were more impacty or not, but we're talking before about how the trade-off between returns and impact should not happen. But unfortunately, I think a lot of people do. And they intentionally, unintentionally, either overpay or don't have the right discipline, and therefore actually get distracted by impact when there shouldn't be, and create lower returns. So there could also be potential of just using impact as an excuse for generating lower returns. So that is also something that needs to be addressed from the LPs to make sure that that is not happening. And on the risk side, I think a lot of investors might not have the resources or the experience to create proper structures, and inadequate structures are a huge issue for the liquidity and exit risk. And then you just get stuck and you don't get liquidity, like you just said. That can be addressed. I mean, proper structures can be addressed. I think a lot of thoughtful investors have kind of waterfall exit structures, anything from put options to redeemable features or convertibles that help mitigate those risks. And then one issue is also stacking too many risks. So you have a bunch of managers, and maybe that goes back into the experience part, where too many risks are stacked on top of each other. So if you're right in a volatile country, the volatile FX rate, in a challenging industry with technology risk and inexperienced management, that's just too many risks. So that might be something that can be mitigated in some ways. But I think a lot of that can be addressed, and I think one is by kind of properly understanding why the overall headline number of returns might not be as bad as it looks. Also appreciating the diversification. I think even if the returns in countries such as Cambodia or others aren't necessarily higher than US returns, you're actually getting diversification benefit in your portfolio. And you have a lot of experience there, obviously, but I think some investors might also have a bit of a perception reality gap around the risks in these countries. But how you can address this is, one, by really proper fundamental investing. And this kind of goes back into what I said in the beginning, really the discipline not to overpay for assets and properly understand them, have the proper structure in place. So, addressing this exit and liquidity risk and actually generating returns for investors, but also understanding returns. Investors might also need a bit of a longer breath, and you're not getting the typical liquidity in like 3 or 4 years like you do in the US. You might have a little bit of a longer time horizon. You can also diversify geographically, which helps a lot. If you just invested in Latin America, for example, well, you're diversified across countries, but all these currencies are so correlated with each other that you're not really creating proper diversification. So when you talk about, Cambodia and other countries in Asia, a proper kind of global diversification approach can help mitigate some of these risks. And yeah, we talked about kind of not sacrificing returns for impact. So I don't know if those are specifically the funds that you're looking at, but I think that is something that is unfortunately often often happening.
Thanks. Let's get to a question from Katja.